Tariffs are back in the headlines, and Trump just turned trade policy into his favorite contact sport. India's in the ring, Europe's dodging punches, and investors, well, they're holding their breath.
Welcome to the Deep Dive. Our mission, well, it's pretty crystal clear. We're here to unpack the latest, frankly, bewildering twists and turns in global trade policy. We want to cut through the noise, give you the clearest picture possible. We've sifted through quite a stack of sources for this deep dive. It's a dynamic mix, really. Live updates, breaking financial news, expert analyses, all fresh as of this Tuesday, September 2, 2025. What we're looking at today, it's not just a collection of isolated events. Think of it more as a journey. We'll go through high-stakes legal battles challenging presidential powers, some intense geopolitical sparring that's reshaping international alliances, and crucially, the ripple effects, how all this impacts markets and, well, your investments, no matter where you are. So maybe grab a coffee, because this one looks like a wild, hopefully insightful ride.
It really is. And, it's not just about what's new in terms of the tariffs themselves. It's the fundamental reevaluation of trade law and really international relations that we're seeing unfold. The underlying principle here is that we're seeing this fresh wave of legal challenges, complex international maneuvering. It could genuinely redefine global commerce for, well, maybe decades. These policy decisions, they're not contained anymore. They're reverberating with incredible speed, incredible impact across courts, boardrooms, national borders, everywhere. This creates a landscape of just unprecedented uncertainty. And understanding why these shifts are happening and what the true stakes are, well, that's paramount for anyone trying to navigate today's global economy. We are talking about structural shifts here, not just temporary blips on the radar.
Okay, let's dive straight in then right into the heart of the storm with our first segment, the legal drama tariffs on trial. And we absolutely have to kick this off with Treasury Secretary Scott Bessent. He seems to be brimming with this almost defiant confidence. He recently expressed his, unwavering belief that the Supreme Court will ultimately uphold President Trump's pretty sweeping use of that 1977 emergency law to impose these broad tariffs. And he's not just talking, is he? He's actively preparing a robust legal brief for the Solicitor General, ready to champion the administration's position right up to the nation's highest court. But help me understand here. Isn't that confidence, frankly, a bit detached from reality? Especially given the appeals court just ruled against him. Is he just, playing to the base, or does he genuinely have a strong legal card up his sleeve that maybe we're not seeing?
Well, that's exactly the tension, isn't it? And it gets right to the core of their legal strategy. Bessent's confidence, it isn't entirely baseless. It's rooted in the specific arguments they plan to make, the ones that will be laid out in that brief. The key insight here is that Bessent's brief isn't just some legal formality. It's a strategic narrative, really, designed to frame the core arguments for using these expansive powers. He's pushing a dual rationale. First, the urgent need, as he puts it, to tackle long-standing trade imbalances.
Framing these tariffs as a vital tool, to level the global economic playing field. That's a classic argument we've heard before from this administration. Second, and this is maybe more controversial, he's linking these tariffs to the critical need to curb fentanyl entering the U.S., presenting it as a national security issue. This dual approach, it's actually quite a clever tactic. It aims to justify the broad application of emergency powers for what are, really at their heart, economic measures. They're basically arguing these tariffs aren't just about trade deficits. They're about protecting national security, safeguarding economic stability.
They hope this broader interpretation will sway the Supreme Court, especially given the court's past deference to executive power in foreign policy matters. They believe this constitutional argument, this broad view, trumps the appeals court's much narrower interpretation of presidential authority. It's a gamble, but it's a calculated one.
So he's gambling on that broader interpretation, almost weaponizing trade policy for national security aims. Okay. But then, just when Bessent and the administration maybe thought they had their legal ducks in a row, boom, we got that major plot twist last Friday. A federal appeals court threw a massive wrench into the works, ruling that most of Trump's global tariffs were, in fact, illegal. And this wasn't just a new challenge, right? It actually reaffirmed an earlier ruling from the Court of International Trade. So it's like a powerful, compounding legal challenge stacking up against the administration.
Exactly. It wasn't out of the blue. It built on the lower court's findings.
And the judges, they were very clear in their decision. They explicitly stated that President Trump exceeded his authority. Using emergency powers under the International Economic Emergency Powers Act, IEPA, as we often call it. Now, IEPA, it probably sounds like a bureaucratic mouthful to a lot of folks listening, but essentially it's a law that lets the president regulate international commerce after declaring a national emergency. But, and here's the crucial bit, the court's interpretation of that word regulate. Well, it clearly didn't stretch far enough to cover the kind of broad, sweeping tariffs the administration has imposed.
That word regulate
Mm.
is doing a lot of work there, and the court put a limit on it.
Right. And this is where it gets really interesting, because the court didn't just stop at saying he exceeded his authority. They went further. They dug into a fundamental constitutional argument. They pointed out quite emphatically that the U.S. Constitution empowers Congress, not the president, to lay and collect taxes, duties, imposts, and excises, and crucially, to regulate commerce. And the court was unequivocal. Tariffs are a tax. Therefore, the taxing power belongs exclusively to the legislative branch, Congress. This isn't just some minor legal quibble, is it? It's a profound constitutional clash. It questions the very boundaries of presidential economic power. The Supreme Court's decision, whenever it comes, will set a huge precedent for decades. It'll shape how future administrations can even think about wielding trade policy.
That's exactly right. The appeals court essentially put a giant spotlight on the separation of powers doctrine. They're saying, look, while IEPA gives the president certain emergency powers to regulate international economic stuff, that power has constitutional limits. It just can't override Congress's explicit authority to impose taxes and tariffs. The judges basically drew a hard line in the sand. They argued that if a president can levy broad tariffs like this under an emergency act, it effectively usurps a power the Constitution specifically grants to the legislative branch. And that argument carries immense weight, because it's not just about these specific tariffs, it's about the fundamental balance of power within the U.S. government itself. It's a direct challenge to the executive's ability to act unilaterally on major economic policy.
So yeah, at its heart, this isn't just trade talk. It's a profound constitutional clash, like you said, questioning the very boundaries of presidential economic power. And yeah, the Supreme Court's decision is going to be defining for decades to come. And if you're thinking this sounds like some kind of dramatic saga, well, you'd be right. It's like a reality show where the tariffs are the contestants, voted off by judges, but still hanging around the house.
That's a pretty good analogy, actually.
Because despite ruling these tariffs illegal, the judges allowed them to remain in effect. This is a critical, almost bizarre detail, isn't it? They're staying in place while the case moves through the, incredibly lengthy appeals process, specifically until October. This window gives the Supreme Court time to weigh in, decide whether or not to even take up the case. So for now, businesses, consumers, everyone's still operating under tariffs that a federal court has declared unlawful. It's strange.
It creates immense practical difficulties, yes. Planning becomes almost impossible.
And how did President Trump react to this particular plot twist? Instantly. To Truth Social, of course. Declared in all caps, all tariffs are still in effect. He didn't mince words. Called the court highly partisan. Vowed to use tariffs with the help of the United States Supreme Court. So yeah, the legal battle is far from over. The administration is clearly digging in for a long fight.
Absolutely. And this creates a fresh and frankly deeply unsettling bout of legal limbo, especially for those reciprocal tariffs Trump unveiled against dozens of U.S. trade partners. The implications of this ruling, if it is ultimately upheld by the Supreme Court, they're truly monumental. It goes way beyond just canceling the tariffs themselves. Let's just look at the financial stakes for a moment. The government's argument, laid out pretty starkly in their legal filings, is that if these tariffs are ultimately struck down, it could mean refunding. Get this, an astonishing $159 billion collected just by July.
Wow, $159 billion.
Billion, yes. And to put that in perspective, that's more than double the amount collected in the entire previous year. Can you imagine the logistical nightmare? The economic shockwave of returning that much revenue? The Justice Department, in one filing, even went so far as to warn that revoking these tariffs could lead to financial ruin for the United States. Now, whether that's slight hyperbole or a genuine risk, it definitely underscores the immense fiscal stakes involved, the potential for severe disruption to the national treasury and, by extension, public spending. These tariffs, you see, have become a significant revenue stream. Its abrupt disappearance would create a massive fiscal hole.
Okay, so huge financial implications. What about the policy side?
Well, beyond the immediate financial hit, the broader implications for Trump's trade agenda, his foreign policy, they're profound. Think about it. If these tariffs are revoked, it effectively strips the administration of a key negotiating strategy, a pillar of its approach to global trade. It removes a powerful cudgel, really. This could potentially embolden foreign governments, right? Make them more resistant to future demands, maybe delay implementing things they already agreed to, or even try to renegotiate terms that were agreed upon under the pressure of these levies. It fundamentally alters the leverage the U.S. has at the negotiating table, potentially weakening its position in global trade disputes. It could signal to the world that the president's trade powers maybe aren't as absolute as the administration presents them. Is there a plan B? Any other legal tool they could use? Well, it's worth noting, they do have an alternative legal authority, the Trade Act of 1974. But, and this is a big but, it comes with significant limitations. That law restricts tariffs to a maximum of 15%. It can only be applied for 150 days, and only on countries where the U.S. runs large trade deficits. So it severely limits the speed and severity of future actions compared to the broad, open-ended powers they've been using under IEPA. It's a much more constrained, less flexible tool for trade policy, which makes this IEPA battle all the more critical for their overall strategy.
Got it. So IEPA is the big hammer. The 1974 Act is more like a small wrench.
Something like that. And it's also really important to clarify what isn't affected by this specific ruling. Tariffs issued under other legal authorities, like Section 232 rules, those are the ones targeting, say, steel and aluminum imports based on national security concerns, those aren't impacted here. They operate under a completely different legal framework, stemming from a different part of U.S. trade law. So the picture is complex. Certain tariffs will remain in place regardless of what the Supreme Court decides on these IEPA-based tariffs.
Which just adds another layer of complexity for businesses trying to figure out their supply chains and pricing.
Precisely.
So what does this all boil down to for you, the listener? Whether you're an individual, maybe running a business, trying to grapple with these constantly shifting trade winds, it means unprecedented uncertainty. In what was already, let's be honest, a deeply complex and volatile landscape, it's not just about the tariffs themselves anymore. It's about the fundamental legal framework for how the U.S. even conducts trade policy. And that uncertainty, it just filters down to every corner of the economy. From consumer prices to big corporate investment decisions, this legal limbo creates a kind of chilling effect. It demands vigilance. Okay, let's pivot now. From the legal labyrinth here at home to some direct diplomatic jabs on the global stage. Our second segment, Trump versus India, a one-sided disaster. President Trump recently shifted his focus, taking direct aim at India's burgeoning trade relationship with the U.S., and he certainly didn't hold back. In his Monday comments on Truth Social, he declared, quite emphatically, that the relationship has been heavily one-sided for decades.
Strong words.
Very. And he was quite specific in his critique, too. He wrote, and I'm quoting here, "In other words, they sell us massive amounts of goods, their biggest client, but we sell them very little. Until now, a totally one-sided relationship, and it has been for many decades. And if that wasn't clear enough," he added, "it has been a totally one-sided disaster." He also claimed India has the highest tariffs of any country. His frustration seems pretty evident. It's almost like Trump saying, India sells us tons, we sell them crumbs, it's the world's most lopsided dinner bill, and no one wants to pick up the check. But is this just rhetoric, or are there real numbers behind this claim of a one-sided disaster?
Well, it's definitely not just rhetoric, although the framing is certainly, let's say, politically charged. When Trump talks about one-sided, he's fundamentally referring to the significant trade deficit the U.S. runs with India. While, specific numbers for this exact moment aren't fully in, historical data does show a consistent, often widening gap. India exports significantly more goods to the U.S. than it imports from the U.S. This imbalance, it's been a sore point for successive U.S. administrations. Actually, not just this one. India, for its part, tends to view its tariffs as necessary tools to protect its own, nascent domestic industries and also to generate revenue, much like many developing nations do. But the underlying principle here, the reason this is so timely, is that Trump's comments about India coincide directly with Prime Minister Narendra Modi's very active efforts to strengthen ties with other major global powers, specifically China and Russia. This diplomatic pivot, this reorientation is happening precisely as relations with the U.S. have visibly deteriorated. It suggests, well, at least a correlation, maybe even a direct reaction, a strategic realignment of alliances.
Interesting timing indeed. So what moves has Modi been making?
Well, take Modi's recent visit to China. It was his first in 7 years, a highly symbolic event. He met President Xi Jinping, and they explicitly discussed cooperation, specifically in the face of the ongoing U.S. trade war, signaling a kind of united front or at least a strategic alignment against U.S. pressure. Xi Jinping's message to Modi was quite pointed too. He emphasized that their long-standing border issues shouldn't define the whole relationship. Instead, he proposed the right choice is for them to be friends, see each other as opportunities, not threats. That kind of rhetoric suggests a deliberate effort to build stronger ties, maybe mitigate the impact of U.S. trade policies by diversifying their economic partnerships.
And it wasn't just China, right? Japan, too.
Correct. Beyond China, Modi also embarked on a pretty significant tour of a chip factory in Japan's Miyagi Prefecture. He was there with his Japanese counterpart, Shigeru Shiba. During that visit, they pledged deeper ties, specifically to strengthen the semiconductor supply chain and enhance economic security. This is particularly significant because Japan, whose crucial car industry has been hit hard by Trump's tariffs, is actively looking to boost trade with nations like India. Japan wants to diversify its own economic partnerships, lessen its reliance on the U.S. market. So India isn't just looking east towards, let's say, geopolitical rivals of the U.S., but also towards other major developed Asian economies, forging strategic alliances in really critical sectors like semiconductors.
Okay, China, Japan, and then there's the whole Russian oil thing, which has been a huge point of friction.
A major point of contention, yes. The U.S. has specifically targeted India over this. Trump imposed tariffs on some Indian exports explicitly to discourage them from buying Russian crude, accusing India essentially of funding Moscow's war in Ukraine. Treasury Secretary Bessent, for instance, explicitly accused India of profiteering, saying they're importing Russian oil at substantially lower discounted prices and then reselling the refined fuel at a much higher rate on the global market, basically benefiting from the sanctions imposed on Russia by Western nations. And White House trade advisor Peter Navarro echoed this, claiming these purchases were directly funding Moscow's war efforts. Strong accusations.
How did India respond to that? Profiteering is a heavy charge.
They pushed back hard. India's oil minister, Hardeep Singh Puri, vehemently denied the accusations. He stated India is not profiting in some nefarious way. Instead, he argued that India's purchases have actually helped stabilize global energy markets. By providing steady demand for Russian crude that would otherwise maybe flood the market, he claims they prevented prices from potentially spiraling to, say, $200 a barrel. He also firmly refuted that laundromat accusation, the idea India is just cleaning Russian oil for resale. He said nothing could be further from the truth, and really emphasized India's sovereign right to secure energy at competitive prices for its massive population. It really highlights the complex mix of economics, geopolitics, and maybe even humanitarian concerns in India's current strategy.
It's clear India isn't just, passively reacting to U.S. pressure. They're being incredibly proactive, quite strategic in their trade approach. They seem to be making pretty aggressive moves to increase pharmaceutical exports to new markets all over the globe. You mentioned Russia, the Netherlands, Brazil, other parts of Europe. This looks like a very deliberate, calculated effort to expand their presence, reduce their dependency on the U.S., which has historically been their single biggest market for pharmaceuticals. Interestingly, their pharma industry is currently exempt from Trump's 50% tariffs. That's a crucial detail. But you said the sector is definitely on edge.
Very much on edge. Despite the exemption, the overall uncertainty hanging over the trade relationship is palpable. And that uncertainty is clearly a powerful driver for their push to diversify into these new markets. It's basically a smart de-risking strategy.
Yeah, makes sense.
And host, what truly stands out here is that India's pivot, as you called it, raises a really important question. Is this purely a direct reaction to sustained U.S. pressure? Or is it part of a broader, maybe pre-existing long-term strategy for India? A strategy to diversify its economic and geopolitical alliances, assert its own role on the global stage as a major rising power. When you look at the totality of the evidence, Modi's engagement with China and Japan on critical supply chains, their steadfastness on Russian oil despite Western condemnation, the active pursuit of new pharma export markets, it really looks like a sophisticated blend of both. There's certainly a reactive element to the U.S. tariffs. Any country would try to mitigate economic threats like that. But there's also, I think, a powerful strategic undercurrent here. India carving out a more independent, multi-aligned global position for itself. It suggests India is seizing this moment of global flux to strategically assert itself. It's not just reacting to U.S. pressure. It's fundamentally reshaping its long-term foreign policy and economic posture. This feels like a long-term reorientation, not just a temporary adjustment to a trade spat.
Absolutely fascinating. And that complexity brings us really seamlessly to our third segment, global ripple effects and market vibrations.
Yeah.
Here we broaden our view. Look at other key players caught up in this global trade arena, because it's definitely not just the U.S. and India feeling these tremors. These trade winds are blowing across the entire planet, forcing countries to adapt, retaliate, or, like India, seek new alliances. Take Brazil, for instance. President Lula has authorized retaliation against Trump's hefty 50% U.S. tariffs. So, on one hand, they're signaling defiance, sending a clear message. We won't be pushed around. But significantly, Lula also indicates a desire to negotiate. He's leaving the door open for diplomacy. It's this calculated mix, isn't it? Muscle flexing and strategic diplomacy, trying to find a path that protects Brazilian interests without completely torching the relationship.
It's a delicate balancing act many nations are facing right now when confronted by these kinds of unilateral U.S. actions.
Then there's Mexico. They're planning to put higher tariffs on Chinese goods in their 2026 budget. Now, this isn't just about protecting local Mexican industry, although that's certainly part of it. This comes amid significant U.S. pressure. Washington's worried that cheap Chinese goods might be entering Mexico, basically circumventing U.S. tariffs before heading north into the American market. So Mexico is kind of trying to appease its powerful neighbor while also shielding its own manufacturing base.
A tricky position for Mexico.
And the real-world impact of these policies, as we know, is immediate, often devastating. We have that poignant story of Fabiola Galicia in Ciudad Juarez. For 11 years, she worked her way up at a factory making decorative ribbons, became a manager, oversaw 30 employees. But her company filed for bankruptcy protection last month, abruptly shut down the Juarez factory, left Galicia and about 300 other workers jobless. Just like that. The company explicitly blamed Trump-era tariffs and rising costs. It just brings home the very real human costs of these big trade disputes. It's not just abstract numbers, it's people's livelihoods.
A stark reminder, yes.
Europe is also caught in this complex legal limbo we talked about earlier. The European Union faces its own challenges with its tariff structure. Listed rates range from 0% to 15%, but there's an ominous 20% announced for certain goods hanging over them. Creates huge uncertainty for businesses trading with or inside the EU. Let me give you a really compelling anecdote here. Thermoplan. They're a highly specialized Swiss coffee machine maker. Turns out they're a major supplier for Starbucks globally.
Oh, yeah.
Their entire future has been, quote, thrown into jeopardy by staggering 39% U.S. tariffs on Swiss goods, piled on top of additional tariffs on industrial metals they need for their machines. The CEO, Adrian Steiner, stated it quite starkly. We're bleeding. He calculates these levies are costing the company millions, lost revenue, increased costs, and as a direct result, Thermoplan is already actively considering drastic measures, moving significant production to Germany, hoping to export under potentially lower EU tariffs, even contemplating moving jobs entirely to the U.S. to try and salvage their business there.
That's incredible. Moving production just to navigate tariff regimes. It shows the scale of disruption.
Exactly. It's not abstract economics. It's forcing companies to make fundamental, almost existential decisions about their operations, their footprint, the jobs they support. Japan is another crucial player trying to navigate this. And for them, as we mentioned, rice remains a sticking point, unquote. The U.S. is aggressively demanding Japan buy more American rice within existing duty-free import caps, also pushing for significant tariff reductions on broader agricultural products. But Japan has clearly stated no plans to lower its tariffs on farm products. You have to understand the political significance of rice in Japan. It's not just a commodity. It's deep in their national identity, their agricultural policy. Any concession is highly contentious domestically.
A hugely sensitive issue in Japan.
So much so that their top trade negotiator, Rosei Akazawa, actually canceled a planned U.S. trip. Cited the gap between the two sides on the issue of rice. Really underscores the impasse. And Japan's frustrated too. They're pushing the U.S. to implement an agreement they reached back on July 22nd to cut U.S. auto tariffs down to 15% from 27.5% and remove the stacking of universal tariffs on top of existing levies. This whole situation just highlights how incredibly difficult it is to actually implement trade deals, even after agreements are supposedly reached. Shows that intricate web of domestic politics, cultural factors, economic pressures that often derail things.
Implementation is often harder than negotiation.
Yeah. Now, South Korea offers an interesting counterpoint, though. Despite facing sweeping U.S. tariffs, their exports actually held up surprisingly well in August, saw a 1.3% increase year over year. This resilience was driven mainly by two powerhouse sectors. Strong semiconductor exports jumped a remarkable 27%, fueled by that surging global AI demand, and robust auto shipments up 9%, particularly finding new markets in Southeast Asia.
So some sectors can still thrive even with tariff headwinds if demand is strong enough or markets are diversified.
Right, but there's a new risk looming for them. The Trump administration recently revoked waivers for major South Korean tech giants, Samsung and SK Hynix. Those waivers had allowed them to use U.S. technologies in their Chinese operations. Revoking those poses fresh, potentially substantial risks to South Korea's crucial tech exports, could disrupt that impressive growth trajectory we just saw.
That's a significant development for the tech supply chain, definitely.
And finally, just briefly, China. Their trade representative, Li Chenggong, recently visited the U.S., held discussions with Treasury, Commerce, USTR officials, the U.S. trade representative. His message was carefully calibrated, apparently, emphasizing the need to manage differences, expand cooperation through dialogue. It indicates that while tensions between the two giants remain incredibly high, there's still some effort, at least from China's side, to keep communication lines open. Maybe find avenues for de-escalation, even as the trade rhetoric continues to intensify.
Dialogue is always important, even amidst tension. But these tariffs and trade frictions, they're not just creating geopolitical static, they're having tangible, measurable impacts on core economic metrics back home. Let's look at that broader economic picture. The U.S. goods trade deficit, for instance, it widened sharply in July, increased by a substantial 22.1%, hitting $103.6 billion. This was mainly driven by imports jumping hugely by $18.6 billion to $281.5 billion. Meanwhile, exports dipped slightly. Think of it this way. When our trade deficit shrinks, it tends to boost GDP growth. But when it expands sharply, like it did in July, it acts as a significant drag on the economy.
How does that connect directly to GDP?
Well, it connects directly. In the second quarter, for example, a sharp contraction in the trade deficit actually added a record 4.95 percentage points to GDP growth. That helped us get that robust 3.3% annualized rate, a huge boost from trade dynamics. However, flip back to the first quarter, GDP actually contracted by 0.5%. And a significant factor there was a sharp deterioration in the trade deficit. That was partly influenced by businesses front-running imports at a record pace before President Trump's sweeping tariffs kicked in. They tried to get goods into the country before the new duties hit, anticipating higher costs. So they sped up orders, creating this temporary artificial surge in imports that worsened the deficits initially.
So businesses reacting to the policy announcements actually skew the numbers.
Exactly. Looking ahead, the current Atlanta Fed estimate for Q3 GDP growth is a more moderate 2.2%. That suggests the initial boost from trade imbalances might be fading or perhaps being offset by other factors, including the ongoing tariff environment itself. It just clearly shows how trade policy directly, profoundly impacts our key economic indicators, the overall health of the economy.
And these aren't just high-level numbers for economists, right? This hits consumers, businesses.
Absolutely. These tariffs directly hit American consumers and businesses. We're seeing retailer warnings popping up, indicating maybe a new wave of pricing pressure that could ripple right through your household budget. Companies across different sectors are feeling the pinch and, well, passing those costs along. Take J.M. Smucker, they own Folgers, Dunkin' Coffee, lots of household brands. They recently warned of more price hikes coming for their products. This follows their U.S. coffee profits plunging 22% under the weight of these tariffs. It hit their bottom line hard.
22% drop. Wow.
Yeah. Similarly, Hormel Foods, think Spam, Skippy peanut butter, they flagged a steep rise in commodity input costs after they missed their earnings expectations for the quarter. Their stock fell 12% on that news. These aren't isolated incidents. They are clear, tangible examples of how tariffs create pricing pressure all through the supply chain, directly impacting corporate performance and ultimately putting upward pressure on the prices you pay at the grocery store or elsewhere.
So this pervasive global uncertainty, it's not just a headline. It's not just for economists or politicians. It directly impacts your investments, the value of your portfolio. U.S. Trade Representative Jamieson Greer said it plainly. While the administration is pushing ahead with trade talks, he also acknowledges, quite candidly, that these levies have, quote, increased volatility in financial markets. So if you're an investor listening, that's not just abstract policy talk. That's a direct signal for how markets might behave.
Expect turbulence, right?
Exactly right. And host, volatility here doesn't just mean bigger swings, bumpier ride. It signifies something deeper, that investors are grappling with fundamental structural shifts in global supply chains and the underlying cost of goods and the very legal and geopolitical frameworks that underpin international commerce. It really raises an important question for everyone listening. How do you effectively navigate a market where policy can literally change overnight or be invalidated by a court ruling just days later? This kind of unpredictable environment, it demands a very specific, very agile approach from traders and investors. Okay, so based on all this, what are some concrete suggestions for investors or traders trying to navigate this?
All right, let me offer a few concrete suggestions, drawing directly from the implications of the source material and these current market conditions. First, seriously consider hedging strategies. While all this volatility plays out, while the legal and geopolitical dust settles, strategies like index puts, which give you the right to sell an index at a specific price, basically insuring against a market downturn, or VIX calls, which are essentially a bet on increased market fear, increased future volatility. These can help protect your portfolio against sudden shocks. It's about building in some insurance against the unknown.
Okay, hedging. What else?
Second, keep a very close eye on export-heavy stocks, particularly in sectors like technology and industrials. These companies are the most exposed to the direct impact of tariffs and any retaliatory measures. Disruptions to global trade hit their sales, their supply chains directly. They can wobble significantly. So watch for potential pullbacks. Those might prevent risks, or for the really agile trader, maybe short-term opportunities. But vigilance is key there.
Makes sense. Anything for short-term traders specifically?
Yes. Third point. For short-term traders, this kind of tariff news creates what you could call intraday whiplash. That means you need to be exceptionally agile, ready for sharp reversals, quick shifts in market sentiment. News breaks, markets react instantly, then they often re-react as more details emerge, legal nuances become clearer, or more official statements come out. This is definitely not an environment for complacency. It requires vigilance, rapid decision-making, and often quicker entries and exits than usual.
That's incredibly insightful, really practical advice for navigating these choppy waters. And speaking of insights, here's a punchy summary line to help maybe crystallize all this for you. Tariffs may sound like foreign policy, but they trade like earnings surprises. Watch your positions, tighten stops, and don't trade tweets like they're gospel.
That's a great way to put it. And building on that, think about the bigger picture again for a second. This legal battle over executive power and tariffs, coupled with this rapid reorientation of global trade alliances we've discussed. India strengthening ties with China, Russia, Japan, Mexico's strategic pivot on Chinese goods, even a country like Switzerland contemplating moving entire production lines just to avoid tariffs. All of this signals a potential long-term reshaping of global commerce. This isn't just a short-term squabble we're watching. It feels like a deep structural shift in how the world trades and aligns itself. So here's a provocative thought, something for you to consider beyond today's headlines. What does this ongoing legal battle ultimately mean for the future of presidential power and trade? And maybe more importantly, how might global supply chains fundamentally shift as countries actively seek out new alliances, new trade partners, specifically to bypass these persistent tariff disputes and policy uncertainties? Think about the long-term strategic implications of these immediate trade skirmishes. It really feels like the global chessboard is being entirely reset right now.
Exactly. It is a lot to consider, and we really encourage you, our listeners, to continue your own research, stay informed, and engage with these incredibly complex, incredibly impactful topics. We hope this deep dive has maybe given you a clearer lens, a better framework for viewing these developments. And remember, this is not financial advice. Always do your own research before making any trades. We're here to spark ideas, maybe ask the right questions, not place your trades for you. Thank you so much for joining us on this deep dive into the, intricate world of tariffs, tribunals, and turmoil.
It was great discussing it. Until next time.
We'll see you for the next deep dive, promising more insights and clarity on the topics that matter most to you.